Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way. So, imagine watching global investors just suddenly pull like nearly $30 billion out of the absolute hottest, most cutting-edge artificial intelligence stocks on Earth.
Right.
And instead of taking all that cash and moving it into, the next big tech innovation, they dumb it all into traditional everyday bank accounts.
Which just sounds completely counterintuitive, right? I mean, it sounds like a glitch in the system.
Totally.
But if you actually look at the market data from this past July, that is exactly what happened.
Yeah, and as an everyday American investor listening to this, you might be trying to make sense of the global economy right now. I mean, maybe you're watching President Trump's current trade policies, you're seeing all these global supply chains shift, and you're just wondering where the safe harbors actually are.
Exactly. You're looking for stability.
Right. And then you wake up and see this headline, the MSCI Asia Pacific Financials Index just jumped by a staggering 8.6% in a single month.
Which is just a historic move.
Oh.
I mean, just to frame how wild that is for you. Those Asian financial stocks beat out the high-flying tech sector by the absolute widest margin on record.
Wow.
Yeah, we haven't seen them outperform the broader Asian stock market by this much since October of 1998.
1998, I mean, that is insane. So naturally, you look at that data and think, okay, Asian banks are doing great. They must all be booming for the exact same reason, right? Like a rising tide lifts all boats.
You'd think so, but if we actually look under the hood, that assumption just completely falls apart.
Really?
Yeah. The rally we're seeing in these Asian bank stocks is definitely not a single unified trend.
So we're looking at completely different engines here.
Absolutely. According to recent analysis, there are basically 5 distinct local economic engines firing at the exact same time across Japan, Singapore, Hong Kong, India, and Australia.
5 different engines.
Right. And they are making money in totally different ways and facing, really different risks.
Okay, well, before we get into the actual mechanics of how, Japan is different from India, I feel like we have to talk about that $30 billion elephant in the room.
Oh, definitely.
Why did so much capital suddenly abandon ship and rush into these Asian banks in July 2026?
Well, the money didn't just appear out of nowhere. You have to look at what investors were actually running away from.
Right.
For the first half of the year, global portfolios were just incredibly top-heavy. I mean, everyone was obsessed with just a handful of AI and hardware tech companies, heavily concentrated in places like South Korea and Taiwan.
Sure, because everyone wants to own the companies that are building the microchips and the AI servers.
Right, exactly. But by July, that sentiment sort of hit a brick wall. Foreign investors actually pulled $22.95 billion out of Taiwanese stocks.
Good grief.
Yeah, and they pulled another $6.26 billion out of South Korean stocks.
That is just a breathtaking amount of capital to move in just a few weeks.
It really is.
But I'm looking at this and thinking, well, are they betting against AI? Did Wall Street just suddenly decide the tech boom is a bust?
Not at all, actually. We aren't seeing massive short positions betting that the AI companies are going to collapse.
So it's not a rejection of tech at all.
No.
It's almost like, well, okay, imagine you've been eating nothing but steak for 6 months straight.
Okay, I like this. You don't suddenly hate steak.
Right, you still love steak.
Right.
But you wake up one day, you realize your diet is just dangerously unbalanced, and you decide you desperately need a salad.
Exactly. Investors had just stuffed their portfolios with so much AI tech that they desperately needed some fundamental diversification.
Financial salad.
A financial salad, yeah. But here is the really crucial distinction. Investors didn't just blindly dump their money into Asian banks because they wanted some boring defensive place to hide out.
Okay, then why banks?
They moved the money because these specific banks are showing really explosive fundamental profit growth.
Oh, so they aren't just defensive safety nets anymore. They're actually generating massive profits on their own.
Precisely.
Which brings us to the first of our 5 engines. What is actually driving this new profit? Let's start with the biggest structural shift in the global economy right now, which is Japan.
Yeah, Japan is fascinating right now because it's completely breaking out of a decades-long cycle.
How so?
Well, for roughly 30 years, Japan has had essentially zero and sometimes even negative interest rates.
Just to pause on that, because for an American listener who is used to, 5 or 7% mortgage rates, 0% sounds absolutely insane. Why did they do that?
Mainly, they were fighting severe deflation.
Okay.
Prices were dropping, the economy was just stagnant, And the Bank of Japan, the BOJ, wanted to force people and massive corporations to spend their money rather than hoard it.
Right, because if your bank account pays zero interest, you're a lot more likely to take that money and invest it into a business or, spend it in the economy.
Exactly. But for a Japanese bank, that zero-interest environment is basically a starvation diet.
Because they can't make any money off the cash.
Right. Banks make their money on a spread, which is the difference between the interest they pay you for keeping your money in a savings account and the much higher interest they charge someone else when they give out a loan.
Ah, so if interest rates are just pinned at zero across the board, that spread gets squeezed to almost nothing.
It's brutal.
Yeah.
But now, that's finally over.
The great thaw.
Yes. The Bank of Japan is normalizing their policy. They raised policy rates to 1% by June 2026, and recent data shows policymakers are seriously discussing hitting 1.25% soon.
Which completely transforms the business models for these megabanks, right? Like MUFG, Mizuho, and SMFG.
It's a total game changer. They're finally able to charge normal interest rates on their loans again.
And that's translating to actual profit.
Oh, massively.
Yeah.
We're seeing their profits jump anywhere from 33% to 48% compared to last year.
Wow. It's like the entire Japanese economy is this massive bear that's been hibernating for 30 years. And now it's finally waking up, stretching its legs, and acting like a normal, hungry animal again.
That's a great analogy. And the market has definitely noticed the bear waking up.
But wait, I'm looking at the performance numbers here. And didn't we see the Topix Banks Index, which tracks these specific Japanese financial stocks? Didn't it already surge by over 40% this year?
It did, yeah.
So if I'm an investor listening to this today, hasn't this train already left the station? Like, aren't these stocks way too expensive to buy right now?
Well, that's the million-dollar question, isn't it?
Yeah.
They certainly aren't the deeply discounted bargain stocks that they were, say, 2 years ago.
Right. The secret is out.
The market has definitely priced in a lot of this good news. But the real risk going forward isn't just the stock price itself. The underlying mechanical risk is the speed of these interest rate hikes.
What do you mean? Don't the banks want rates to go up as high as possible?
They do, for their new loan business. But Japanese banks also hold a massive amount of Japanese government bonds on their balance sheets.
Okay.
And there's a fundamental rule in finance. When interest rates go up, the value of existing bonds goes down.
Oh, right. Because if I hold a bond paying 0.5% and suddenly the government issues brand new bonds paying 1.5%, nobody wants to buy my old low-paying bond anymore.
Exactly. Its value drops on the open market.
Wow.
So the Bank of Japan is walking this very delicate tightrope. Higher rates are fantastic for the bank's new loan profits. But if those government bond yields rise too fast, the banks take a massive hit on the value of the bond portfolios they already own.
Okay, that makes sense. So Japan is making its money through interest rates, which is the classic traditional banking model.
Right.
But let's pivot now, because the next engine on our list relies on something completely different. Let's look at Singapore.
Singapore is wild because the data presents this complete contradiction to what we just talked about. Well, we just established that higher interest rates and a wide spread are how banks make money, right?
The Japanese model.
Right. Well, in Singapore, banks like OCBC, UOB, and DVS are actually seeing their profit margins on interest drop. Their net interest margin is shrinking.
Wait, a shrinking interest margin should be terrible news for a bank? I mean, if they aren't making money on the spread between deposits and loans, how are they keeping the lights on?
By just not relying on loans anymore.
What do you mean?
Despite those shrinking interest margins, Singaporean banks are reporting record-breaking profits. They have fundamentally transformed from traditional lending institutions into Asia's premier wealth management platforms.
So they aren't making money off interest anymore. They are making money off fees.
Huge fees. I mean, by the end of 2025, the assets under management in Singapore hit 6.7 trillion Singapore dollars.
Trillion with a T.
Yes. They're managing the immense wealth of the entire regions, billionaires, huge family offices, and millionaires. They charge massive fees for private banking, complex trading, estate planning, and insurance.
So it's basically like a luxury hotel model.
How do you mean?
Well, think about a really high-end resort concierge. They don't actually care if the nightly rate of your hotel room drops by $50. The room itself isn't the real moneymaker.
Oh, right. It's just how they get you in the door.
Exactly. Once you're checked in, they are making an absolute fortune selling you VIP city tours, luxury spa treatments, and exclusive private dining experiences.
That's entirely it.
The Singaporean banks don't care if the margin on a basic business loan drops because they're making all their money managing your family's global trust fund.
That is a spot-on way to look at it. And Singapore has positioned itself perfectly as this geopolitically neutral, highly trusted legal and financial hub. Capital from all over Asia is flooding there just to get access to that exact concierge service.
Which is fascinating. Now, Hong Kong is also a major Asian wealth hub. Are they running that same concierge playbook over there?
It's a similar fee-based engine, yeah, but with a slightly different core function. Hong Kong isn't just managing family wealth, it's booming as a top IPO market.
IPOs. So, initial public offerings, where companies list on the stock exchange to raise capital for the first time.
Exactly.
So, they are acting as the gateway for huge corporations, not just rich families.
Right. They had 115 IPOs in 2025 alone, raising billions of dollars. Hong Kong essentially functions as the primary offshore capital market for mainland China.
Got it.
When a massive Chinese tech firm or a huge manufacturer needs to raise global capital, say they need US dollars or euros, they do it in Hong Kong. And that generates astronomical fees for investment banking, underwriting, and trading.
But there has to be a catch here, right? A vulnerability. Because Singapore sounds incredibly stable because of its neutrality, but
Yeah.
Hong Kong is, well, deeply tied to mainland China.
And that is the exact bottleneck for them. Hong Kong's greatest strength, which is its pipeline to Chinese wealth, is also its biggest risk.
Because of the government.
Because Hong Kong relies so heavily on money moving out of the mainland, so it is incredibly sensitive to China's strict capital controls.
How does that actually play out in the banking sector day to day?
Let's look at a real-world example from the recent data. Historically, wealthy Chinese citizens would buy massive offshore insurance products in Hong Kong.
Wait, what? Insurance? I mean, if you want to invest your money, why not just buy stocks or real estate?
Because of how the capital controls work, it's actually very difficult to just wire millions of Chinese yuan out of the mainland into a foreign bank account.
Oh, I see.
But buying an insurance policy in Hong Kong was this legal gray area. You buy a massive policy denominated in Hong Kong dollars or US dollars, and suddenly a huge chunk of your wealth is sitting safely outside of mainland jurisdiction.
So it was essentially a back door to get your money out of the country.
Exactly. But recently, Chinese authorities started heavily enforcing a 20% tax on those exact offshore insurance products. They cracked down on the loophole.
Wow. And what happened to the Hong Kong banks when they did that?
The moment that enforcement made headlines, Hong Kong financial stocks like AIA and Prudential just took a massive hit.
So Hong Kong is basically a toll bridge.
A toll bridge?
Yeah. It makes a fortune connecting Chinese capital to the rest of the world. But if the mainland government decides to suddenly raise the toll or just close the gates completely, the traffic on that bridge stops instantly.
That is the perfect way to visualize it, yeah. The risk in Hong Kong isn't about interest rates or inflation. It's entirely about regulatory bottlenecks and capital movement.
Okay, so we have Japan riding the interest rate normalization, and we have Singapore and Hong Kong running these massive fee-based wealth and capital hubs.
Right.
That brings us to engine number 4, India. If Singapore is the mature, sophisticated wealth manager, India feels like something completely different.
Oh, India is the classic, raw, explosive emerging market. It is all about domestic growth and just massive scale.
What does that actually look like on the ground for these banks?
The numbers are frankly staggering. State Bank of India, which is the country's largest bank, they saw a year-over-year loan growth of over 18.6%.
18.6% in a single year.
Right. You have this massive emerging middle class buying their first cars, taking out mortgages for their first homes, and local businesses are just taking out loans to expand their operations.
It's a total boom.
And the most interesting part is that global Wall Street is jumping in to fund it.
Yeah, I saw this in the recent numbers. Bank of America recently dropped $1.92 billion just to take a stake in Jio Credit, which is an Indian non-bank lender. I mean,
Yeah.
that isn't just a minor partnership.
No. Committing nearly $2 billion in equity to a consumer credit sector halfway across the world is a massive vote of confidence.
For sure.
Bank of America is looking at India and saying, this domestic growth is sustainable and we want a piece of the loan profits.
It feels like India's economy right now is like a teenager hitting a massive growth spurt.
That's a really good way to frame it.
Yeah, Yeah, think about like a 14-year-old growing 3 inches in a single summer. They are just eating absolutely everything in the fridge. They can't get enough
Right,
calories.
they're starving all the time.
In India's case, the calories are capital. The loan demand is just voracious. But looking at the banking numbers, I spotted a huge red flag here.
Oh.
Yeah, loan growth was 18.6%, but bank deposits only grew by 9.7%.
And that right there is the exact structural friction that global analysts are sweating over right now.
Well, yeah, because if the teenager's eating through the fridge that fast, eventually the parents are going to run out of money to buy groceries.
Exactly. The fundamental rule of traditional banking is that you absolutely need deposits to fund your loans.
Right.
When you deposit your paycheck into a checking account, the bank turns around and lends that exact cash out to someone else who's buying a house.
So if you are lending money out at 18%, but people are only depositing money at 9%,
Yeah.
you literally run out of cash to lend.
You do. And to fix that, what does the bank have to do? They have to beg people to deposit more money
And how do you do that?
by offering higher and higher interest rates on your savings accounts.
Ah. And when the bank has to pay me 5% on my savings account instead of 2%, their profit margin on the loan they just gave out gets completely squeezed.
Precisely. The Indian economic engine is roaring, no doubt, but that deposit gap is the friction that could seriously slow it down.
Mm.
They need more raw domestic deposits to keep the loan machine running without crushing their own profit margins.
Right, this is a fascinating map so far. We've looked at 4 distinct roaring engines. Japan waking up, Singapore collecting fees, Hong Kong acting as a capital bridge, and India growing at breakneck speed.
Yes.
But to give you a complete, honest picture of the Asian financial sector today, we have to look at an engine that might actually be overheating. And that brings us to Australia.
Right. Now, if you just glance at the surface level metrics, the Australian banking sector looks bulletproof right now.
It really does.
Australian consumer spending has been surprisingly resilient. Because of that, their central bank, the RBA, has kept interest rates elevated, sitting at 4.35%.
And as a result, massive institutions like the Commonwealth Bank of Australia, or CBA, are reporting record cash profits. I mean, they are throwing off huge dividends to their shareholders.
On paper, it looks like a massive win for everyone involved.
But wait, I'm trying to connect the dots here. Didn't we just spend the first 10 minutes of this deep dive talking about how higher interest rates were a massive win for Japan?
We did.
So why is a 4.35% interest rate suddenly a warning light for Australia?
Because interest rates are essentially medicine for an economy. The right dose cures inflation and helps banks build a healthy profit spread. But an overdose becomes toxic.
Okay, where is the toxicity showing up in Australia then?
In the housing market. If you look under the surface of those record bank profits, mortgage applications for the major Australian banks have recently plummeted by 15% to 28%.
A 28% drop in mortgage applications. That means a massive chunk of the population has completely stepped away from buying homes.
Exactly. The high interest rates are starting to crush the average Australian home buyer. It is simply becoming too expensive to borrow money.
Oh, wow.
We talked about rates going from freezing cold to comfortably warm in Japan. But in Australia, they're going from comfortably warm to boiling hot.
And when the water boils, people don't just stop taking out new mortgages, right? What happens to the people who already own homes but are struggling with the higher monthly payments?
That is the tipping point. They start defaulting on their loans. And defaults are a bank's absolute worst nightmare.
Because they lose the principal.
Exactly. It doesn't matter how high your interest rate is if the borrower stops paying you entirely.
Are we actually seeing defaults rise, though?
We are starting to see the cracks, yeah.
Mm.
CBA actually reported a 9% increase in their bad debt expenses recently.
Yikes.
So the flashing warning light on the Australian dashboard is that these banks are paying out record dividends today based on past profits. But the very high rates that created those profits are now actively choking off their future growth and hurting their borrowers.
That is an incredible breakdown of the mechanics here. So let's pull all of this together for you listening right now. The biggest takeaway from all of this analysis is that you cannot just throw your money into a generic Asian bank ETF or a broad international fund and assume you understand what you own.
Right.
You can't just read a headline that says Asian financials are up 8% and think it's one simple story.
Because it absolutely isn't. You really have to understand the specific local mechanics driving those profits.
Right. Let's look at the map one last time. If you buy into Japan, you are writing a historic once-in-a-generation normalization of interest rates.
Hmm.
If you buy into Singapore, you are essentially buying a geopolitically neutral wealth management concierge.
And if you buy Hong Kong, you are buying a toll bridge for Chinese capital, and you're accepting the regulatory risks that come with it.
Exactly. If you buy India, you are buying raw, aggressive credit growth driven by a booming middle class.
And if you buy Australia, you are buying a massive dividend yield, but you might be masking some very real underlying stress in their local housing market,
They're completely different animals.
which highlights exactly why looking closely at the underlying mechanics is so vital. It protects you from making lazy assumptions based on a single broad headline.
Absolutely. Now, I want to leave you with one final, slightly provocative thought to chew on today.
Okay.
For the last year or two, everyone in the American market thought the only way to make serious money was by chasing the fastest, smartest, most cutting-edge AI technology, right?
That was the whole narrative.
But looking at these international banks, isn't it absolutely fascinating that some of the most profitable investments right now are just companies acting as the reliable plumbing for everyday human life?
The plumbing of the global economy. I think that's exactly what this is.
Right. We are talking about the basic, unglamorous infrastructure of society. It's people buying their first houses in India. It's families storing their life savings in Singapore. It's small businesses expanding their storefronts in Tokyo.
It's a really powerful reminder that while technology like AI changes rapidly and grabs all the front page headlines, fundamental human needs and the financial systems built to facilitate them are just deeply enduring.
Yeah. Maybe the future of the global market isn't just about artificial intelligence taking over everything. Maybe there is massive overlooked value in actual boots-on-the-ground human commerce. People still need to live their lives, and banks are the engines that power those lives. Don't forget to subscribe and hit that like button.